Hi everybody, Marco Carbajo here from businesscreditbuilders.org. Today's video we're going to talk about how to get approved for a business line of credit. This is part one of a two-part video series. Today we're going to talk about bank options that are available to you. This is very important for those of you, whether you're a startup or existing business. We're going to share with you how to actually get approved. What do the banks and lenders actually look at when it comes to approving you for a business line of credit? So let's get started. The first thing I want to talk about is when you're going to traditional types of business lines of credit, whether it's a bank, a credit union, or a community bank, there are two types of lines of credit you can acquire as a business. There's a secured business line of credit and an unsecured business line of credit. In this video, we're going to talk about those two options today and how to get approved for them with a traditional bank, credit union, or a community bank. What do they actually look for? So a secured business line of credit is a collateral-based line of credit. This is best if you're a business that has assets, whether you have cash on hand, whether you have CDs, you may have real estate, inventory, equipment for the business. This is collateral that you have to put up to secure that line of credit. This is an easier type of line of credit to get approved for because the bank has less risk because you're collateralizing the line of credit. So in the event of default, you as a business do not pay on your line of credit. Let's say there's an outstanding balance, you cannot pay, then the bank has the ability to seize that collateral, whether it's cash you put on deposit or a CD or equipment or even your inventory. So that's where the bank minimizes its risk. So the requirements for secured business line of credit is typically out there, the banks want to see you have 2 years in business. There are some banks that allow you to even be a startup like under 2 years. If you do have strong collateral, they may accept you for a line of credit. Annual revenues they like to see minimum is $100,000 a year in revenue. Your credit score is a little less demanding with a secured line of credit than an unsecured line of credit because of the fact that you're collateralizing, you're putting up collateral for the line of credit. So they will reduce your credit score. You can get by with a 650 or higher credit score. So as you know, with unsecured, there's more risk to the bank. So they want you to have really strong personal credit, like a 700 or higher, which we're going to get into next. But credit scores for this are typically 650. Business credit established for your company. Will they run a business credit check? Most likely they will, but it's not required for a secured business line of credit. You can get by if you haven't established a credit history, you don't have a payback score, that's okay because you're, again, like the collateral is making up for a big difference there. Now, what are you going to need is you're going to need to provide bank statements. So you want to have that ready because that's the thing they're going to look at is your revenue, your cash flow coming into the business. And they're also going to do a valuation on the collateral. What type of collateral do you want to put up? Now, depending on the bank, there's certain collateral they will accept. Some banks don't accept certain types of collateral. Easiest types, of course, is cash or CDs or equipment or accounts receivable, like inventory is another option for collateral. So these are the types of things you're going to need for a secured business line of credit. Now, when it comes to cash flow, this is the key thing that most people don't understand. Even though you're putting up collateral, you can still get declined for a secured business line of credit. Why is that? Is this certain formula called the debt service coverage ratio. And many business owners may not be aware of this or what they need to be at, what ratio in order to get approved. So for a secured business line of credit, typically on an unsecured, the banks start at a 1.25 ratio is where they want you to be. With a secured business line of credit, it's typically more flexible. So 1.10 is your debt service coverage ratio. Now, what does that actually mean? And I'm going to break it down to you. If you're not familiar with this ratio, this is going to help you when it comes to getting approved. Your debt service coverage ratio is your net operating income divided into your total debt service. So I broke this down right here on the screen, so I'll make it really simple for you. For a secured business line of credit, even though you're putting up collateral, you want to be at a 1.10 debt service coverage ratio, which basically means your business has to earn 10% more cash flow than required to cover all your loan payments, including the new line of credit that you want to get approved for. An example is, let's say you have $80,000 in annual debt payments right now as a business. That's what all your payments are annually to pay your existing debt. And you want to get more lines of credit for your business. Now this new line you're trying to get approved for is $20,000 in annual debt service in addition to your $80,000. So that's $100,000 in debt payments you're going to have to make as a business. So what the bank's going to want to see is they want to see a 1.10 minimum because you're securing a line. So to meet that ratio, your business must show it's generating $110,000 in net operating income or higher. So see, there's a little cushion there, 10%. All right. So just so you understand, what does that mean? What do you mean 20,000 annual debt service in addition to what I'm already paying? So when it comes to a line of credit, 20,000, the example here is that's a $250,000 line of credit. Let's say the interest rate's 8%. If you maxed out that $250,000 line of credit and your interest only payment is 8% annualized, that's going to be $20,000 in debt payments just to service that debt in interest alone. Typically, lines of credit are interest-only payments. So you're paying interest only, and then you can pay the principal in addition to that interest-only payment. But that's what they do is they see, can you service how much? And if you max out the line, doesn't mean you have to max out that line of credit. Of course, your payment's going to be much lower if you don't max it out, but that's what the bank looks at and how much can you service on this new line of credit and debt that you're going to take out. All right, so I just want to make sure you understand that when it comes to a secured business line of credit, your debt service coverage ratio should be 1.10 or higher, which is, if it's higher, it's better. Your bank relationship is preferred with active checking account history. So if you do have an existing relationship with a bank that you want to get a line of credit for, that's also helpful. It's not mandatory, but it's something that does help when it comes to getting approved for a secured business line of credit. Typical credit limits and terms. Secured, you're going to have to put up that collateral. So most banks that are offering secured business lines of credit have a minimum $10,000 secured line. So that means you have to come up with $10,000 security deposit, whether it's cash, inventory, accounts receivable, etc. And they go up to $1 million. So it's much higher lines they do because it's secured. You're backing up with collateral. Now, there are some banks that do less than $10,000. One of them, I believe I'm going to share with you in a minute, which banks do secured lines, but $10,000 is the typical range. As far as interest rates, what are you going to pay on a secured business line of credit is typically the prime plus 1 to 3%. Because you're putting up collateral, there's less risk, so the bank's willing to give you a much lower rate. Now, what is prime plus 1 to 3%? You might see that and say, what does that actually mean? The prime rate is the set interest rate that banks across the country, pretty much, it's the best rate they give to the big corporate borrowers that they have. And banks have this prime rate that changes from time to time, and they mainly base it off the Fed rate, the rate the Fed puts out. And then the banks put typically around 3% on top of that. That's called prime rate. When you see prime plus 1 to 3%, that means that's the rate you're going to pay on this particular line of credit. So if the prime rate, let's say it's 5% right now, and you can look that up when you go to the Wall Street Journal and look up money rates, you'll see what the prime rate is currently. If it says it's 5%, then if your credit line is prime plus 1%, then if the prime rate's 5, your interest rate currently would be 6%. That's 5 plus 1%. So that's your 6% rate. Let's say next year, though, the prime changes to, let's say, 6%. Well, now your credit line interest rate is going to be a 6% prime plus 1%. That's 7%. And that's why your interest rate could change on this type of line of credit. So just keep that in mind, but that's still really good on a secured line of credit. For those of you who are really looking to get the best type of rates, a secured line of credit is the way to go because it's less risk to the banks. As far as renewal, with a secured line of credit, they do an annual renewal typically. They're going to still look at your financials every year, even though you have backed up this line of credit. Now, what type of banks do offer a secured business line of credit? Bank of America does, PNC Bank, Wells Fargo, Fifth Third Bank. So these are just a couple of the banks that offer a secured business line of credit. Not every bank offers this particular type of line of credit that you can get. This is one of the most favorable for businesses. They want a bank business line of credit. The next one we're going to talk about is an unsecured business line of credit from a bank, a credit union, or community bank. So this is the approval, typically things to look out for when it comes to getting approved for a secured business line of credit. These are the things they look at. For an unsecured business line of credit, this is best for established businesses with credit and cash flow. So if you've been in business for 2 years or more, you have some cash flow coming in, you have good credit, for the business and you have good, decent credit as an individual, this is one of the most preferred types of line of credit that many people come to us and say, I'm wanting a traditional business line of credit. But many times they don't meet the requirements. I want to break down to you what banks look for and what you should make sure to expect this type of line of credit. If you don't meet the secured line of credit, let's say you don't have the collateral, and let's say you don't meet the unsecured, then you have to look at other types of lines of credit that you may qualify for, which we're going to cover in part 2 of next week. So we're going over all these different types, 4 major types of lines of credit you can get for your business. So for an unsecured traditional business line of credit from a bank, credit union, or community bank, time in business 2 years is typical. They want to see a track record. They want your annual revenue to be $200,000 in annual revenue. Your credit score 700 or higher. So they do want you to have really good personal credit. That's going to play a factor. There's many times people come to us and they say, well, I have revenues, but I got declined by my bank because I only have a 650 credit score. Or I have a 600 credit score. I went through a tough challenge, or they went through a divorce, or whatever it is, and the bank turned them down even though their business is doing well. Don't worry, there are other options which we're going to cover next week, or there's also the secured business line of credit option where you only need a 650 score, but you may not have the cash or collateral to back up the line. So that's where all these little things play a role. It's important to you to know what may trigger a bank to deny you for a typical line of credit. Now, established business credit history is expected when you want to get an unsecured business line of credit from a traditional bank. They're going to run a credit check on your business. They're going to run a personal credit check on you as well. So if you have no business credit established whatsoever, that can hurt you. All right, that may not trigger automatic denial, but it may if the business is fairly new, or if your personal credit is not strong enough. That's why establishing business credit history is very, very important. You want to have your 80 paydex score. You want to have a track record. You want to have your Experian and Telescore established, your Equifax business credit report established, depending on which business credit bureau the bank pulls from. And you can inquire with your bank which business credit bureau do you pull from if you want to know ahead of time. Financials, they're going to want to see full docs when it comes to an unsecured business line of credit at a bank, especially one that you don't have an established relationship with. If you do have an established relationship with this bank, you've been banking with them for a long time, you have your business checking account with them, they can see all your cash flow coming in, cash flow going out. Let's say you have a personal checking account with them, you have cards with them, then they may overlook some of these things or may not require as much excessive documentations. But typically, a bank will want to see full docs. They may even want to see only a year's business tax return compared to 2 years. But they may want to see your P&L, balance sheet, all your financials, your business debt schedule. So these are the things, just be aware when you're dealing with an unsecured business line of credit from a bank. They're going to do a much more thorough review. All right. And most business owners like to see less documents. Like, I don't want to provide all these documents, or I don't want to provide my P&Ls, or my tax returns aren't done yet. Well, then you have to look at other types of lines of credit if you're not willing to put up this documentation that a bank will want to see. Okay, so that's just the reality when it comes to these types of lines of credit, and this is what to expect to provide, and this is what the banks look for. Now, when it comes to this unsecured business line of credit, this is the debt service credit ratio I talked about earlier. It's different for an unsecured. What I mean by different is it's more strict. It's 1.25. That's the typical, or higher. Like in the example I gave you, this is the same example, but see, the difference is your business must show 125 in net operating income or higher for the same scenario I talked about earlier. All right, so this is why is it higher? Because it's more risk. You're not putting up any collateral. It's completely unsecured, so the bank's going to want to see this extra cushion, 15% more than unsecured. So we talked about 1.10. This is 1.25. So that's something you could calculate on your own. What are my current debt payments? What's my debt service cover ratio I have right now? Is it 1.25 or is it higher? So that's something to take into consideration, because that could be a reason why you may have gotten declined and you weren't aware that your business can't support an additional debt load on this new line of credit that you're trying to get. Bank relationship is preferred. Again, it does help with an unsecured business line of credit. Typical credit limits with unsecured is not as huge it's not as large with a secured because it's uncollateralized. It's more risk for the banks. So typical limits, 25,000, 150,000. Rates are also a little higher than secured because, again, this is more risk. The bank doesn't have any collateral so that you're putting up. So prime plus 3 to 6% is typically the rate you can expect from a line of credit at a bank, credit union, or community bank. So when it comes to those of you who are rate sensitive, you're looking to get the best rates. Remember, traditional banks, credit unions, that's where you're going to get the lowest rates possible. But in order to get those rates, you have to meet higher requirements, which I'm showing you here on this video. Next week, there are some ways around that. We're going to talk about credit cards next week. We're going to talk about alternative lenders. But there is a share there. The less documentation, there's more risk. When there's more risk, you're going to be paying more for the money you borrow. So that's just the reality when it comes to borrowing money as a business. Renewal is the same thing. Annually, they're going to renew you. They want to make sure that everything is up to par when you applied. If they see a high risk, they might reduce your credit line. That does happen. That's why I always talk about diversifying your access to credit as a business. If you only have one line of credit right now as a business with your bank, you want to explore other banks to have additional lines with, or maybe also have additional credit cards, alternative lines of credit set up, because you don't want to put all your eggs in one basket with one bank. You don't want to have, this is the one bank I have my line of credit, I have my cards with them, I'm all set, I don't need anything. That's the biggest mistake you can possibly make, all right? Because that's putting all your eggs in one basket. And any time a bank, if the market, let's say the economy gets tough or something like that, and the banks start reducing credit limits, and we've seen that happen in the past. Businesses go out of business because they don't have access to credit anymore because all their lines of credit were tied up with one bank. That's why you want to have multiple relationships, multiple lines of credit, different sources of credit available to you. Now, I want to share with you, for those of you who don't meet these requirements or want more of a line of credit, but let's say you don't have all the documentation you want to put up, but you're generating healthy revenues, you have cash flow coming into your business, but let's say even your credit is not up to par. I want to share with you a line of credit that we talked about in a previous video months back. It's called the Business Line of Credit from ARF. This is an actual line of credit. This is not a merchant cash advance or anything like that. But this is one option I'm going to share with you. And I'm also, after this, going to share with you another option where we can explore other types of lines of credit that you may qualify for. But this particular line of credit, they have lines of credit up to $1 million. This is completely unsecured. So you're not putting up any collateral or anything like that. It has less requirements than traditional banks and credit unions. So this is, I'd like to say, a little sweet spot that you may fit into this if you can't get a line of credit with your bank, or let's say you already have a line of credit with your bank and you're wanting to open up another access of credit availability for your business. The minimum draw, though, when you get approved for a line of credit, though, with ARF, you do need to pull out at least a 10% of your line of credit approval, or minimum $5,000. So they want you to draw on your line of credit right away. So this is something they want you to use initially. Now, they do have repayment terms up to 36 months. So where banks and credit unions, they typically have, and community banks have interest-only payments, this, when you draw on your line of credit, you have 3 years to pay it back. So it's a little different from a traditional line of credit that has interest-only payments. This has it amortized over 36 months, where you're going to pay it back within a 36-month period. So with unlimited draws, 5,000 or more during your revolving period, every payment frees up your amount of credit that you have available. There's no prepayment penalties. So if you want to pay it off early, that's fine. This does help you build business credit as well. Now, do not go to ARF Business Line yet to apply, because I want to make sure you don't apply if you don't meet their qualifications. This is the one mistake. When we did a video previously, many people started applying for this, didn't realize that they were in a restricted industry, because ARF does have certain types of industries they will not extend a line of credit to. So please stay in this video and wait till we get to the next slide after this, where we're going to go over the restricted industries and the preferred industries, which is really important for this type of line of credit. So industry type is really, really big when it comes to ARS line of credit. They have other line of credit products. There's the bankroll line of credit is one of the most popular. There's interest-only line of credit that they have as well. But the credit score, they do an Equifax soft pull only. So they're not doing a hard pull, and you only have to have a 551 credit score. So whereas we talked about on the secured line of credit where you had to put up collateral and had to have a minimum 650, or an unsecured, you have to have a 700 credit score. This, they go as low as 551 on your Equifax credit report, and it's a soft pull. Time in business, you don't have to be 2 years in business, you could be 30 days in business. So that's another benefit. But you have to meet their revenue requirement. Minimum is $17,000 per month in gross revenue, or $200,000 annually. If you're doing $10,000, $12,000, $15,000, do not apply. All right, so you need to meet that minimum gross revenue of $17,000 or more per month. There's no collateral you have to put up for this line of credit, no tax returns, and no financials. Now, this is the important thing, is the approved industries. You could pause this video right now if you want and look over this approved industry. There is an expanded industry next. So if you don't fit into one of these industries, don't worry. There's another slide too where they do an extended, and they will look at your industry if you fall into that category. But what they do love, what's their sweet spot, is they love brick and mortar businesses where you actually have a storefront, or you actually have a physical location, not a virtual office, an actual brick and mortar business like a restaurant or a bookstore or a nursing home or a motel, like your actual business that has an actual location. That's what they look for, and that's what they love. So if you're falling into this approved industries, you definitely want to take a look at this line of credit. Now this is their expanded industries as well. So if you didn't fall into the first one, they'll still look at you and consider you for a line of credit if your business falls into any one of these industries right here. The next slide, which is most important, is the restricted industries. These are the industries, if you fall into any one of these, I'm sorry, they will automatically say, no, we can't help you. Whether in some of those industries, unfortunately, are home-based businesses. If you're in any type of online auctions, or I mean, obviously you can look at this list, you can press pause and say, oh, this is the industry I'm involved in. If you're in real estate, or if you're in property management, or if you're in the trucking industry, unfortunately, this line of credit doesn't work for you. Now, keep in mind, we've had people who started out in a high-risk industry and they changed their industry. Let's say they're in a different industry, but they never changed their classification code, or they never changed their website, or they never updated their state filing records to say that this is the industry they're involved in. And so keep in mind, they do their due diligence, they do their review, they look up your documentation. So those are things that you want to make sure you have all your ducks in a row before you apply for this line of credit. But it's a powerful product. But let's say you're not sure. I mean, you're looking at all this information. You say, how do I know what type of line of credit I qualify for? What can I do? Well, that's where we offer a free pre-qualification review. We can take all that guesswork out of you, off of your hands, and do a review for you to see what type of options do you have right now where you stand. And we could do a review and also give you some potential solutions. Let's say you have credit challenges, or you're not doing enough revenues, but did you know that you qualify for this funding product? Or did you know this is an option for you? And that's what we like to do, is give you options. But there's no hard credit pull for us to do a review only. You're providing us a copy of your credit report for us to do a review. And this credit report cannot be older than 4 weeks old. Okay, so it has to be less than 4 weeks old for us to do a review. It has to be a PDF document. It can't be a picture of your credit report or a picture of your credit score. We won't accept that. We need to see a full credit report where it shows credit limits, individual payment history, individual credit limits for each card or loan, payment history, etc. But we give you results in less than 48 hours. So once you submit the pre-qual form, it takes less than 1 minute, 2 minutes to fill out. Upload your report. 48 hours, we're calling you back with funding projections. And you could see all your options. You could see, do you qualify? We can acquire this much in business credit cards for you at 0% rates. Plus, we project we can get X amount of loan funding for you. And some business owners opt for both. They want to get as much funding as possible. And in that 14 to 20 days, we acquire multiple types of funding products for you to get the most capital, if that's what you're looking for. This will help you maximize your approval because of the amount window that we take when it comes to processing your application, the order in which we apply for you on your behalf. That saves you time, it saves you money, and you're able to maximize your approval during that window. This also helps you build business credit. Many of the funding products that we acquire for you, such as business credit cards, report to the business credit bureaus. They don't report to your personal credit, so this will help you establish credit history as a business. And the funding process is really fast. It's 14 to 20 days for us to do this funding for you. So you're simply going to go to businesscreditbuilders.org. That's going to take you to our website right here, and you click on this Pre-Qualify Now tab, and that's where you fill out the pre-qualification form, and you're going to upload a copy of your personal credit report securely here, and you click Submit. So that's how simple it is for you to start the pre-qualification review. Now on the ARF business line, I just want to share you, this is the screen you're going to see on ARF if you want to apply for that line of credit. Just go through that little simple questionnaire. You will need to upload bank statements for them to do the review to pre-qualify for that line of credit, but just make sure you don't fall in their restricted list, because they will decline you. They will refer you to us for us to do this particular review for you, because we have many other options available. Now, for those of you who do have personal credit issues, and let's say your credit is holding you back from getting a traditional line of credit from a bank or a credit union, then definitely check out our AI Credit Pro software. This is a credit repair software that uses artificial intelligence. It's really, really powerful. If you go to businesscreditbuilders.org and you click on our AI Credit Repair, you'll see right here this video, and you can watch that credit repair video right there. The software is absolutely free. You will need to subscribe to the monitoring service, so the monitoring service can upload your credit reports to the software. That way we can, the AI can do all the review, create customized disputes for you, and monitor your progress. But that's a really powerful software you want to take a look at. And of course, we have our business credit building system. For those of you who are looking to build up your business credit, check that out at businesscreditbuilders.org. So this is part one of a two-part video series on how to get approved for a business line of credit. Next week, we're going to talk about alternative lenders. We're going to talk about business credit card funding as your other two types of business lines of credit you can get for your business, and what it takes to get approved. So if you found this video helpful, give us a thumbs up, click subscribe. That way you're notified every single time that we come out with a new video. Take care, make it a great day, and we'll talk to you real soon.